Petroleum products are marketed as motor fuels, heating oils, industrial fuels, as well as for energy generation, or as raw materials for further processing to produce other products. Petroleum serves as a raw material for thousands of products that range over a large part of our daily lives, and it is the basis of modern way of living. Petroleum will still be used for many years to come to play an important role in humanity. However, with our society being over-reliant on fossil fuels, there are long-term disadvantages such as scarcity and the most talked topic now, climate change. The future remains uncertain with the increasing global population as well as the increased energy demand. It is now or never to realize that we will be needing more energy, food, and resources tomorrow than we ever do today. Oil and gas industry provides millions of jobs opportunities, controls the world economy, and have a significant impact on political stability of a country. In Malaysia, this sector contributes 35% of the government revenue. The increase of oil prices will lead to a higher operational cost for most businesses and thereby reduces corporate and other business earnings. In order to prevent huge losses of profits, factors that significantly governs the volatility of oil and gas stock prices are needed to be identified early on. As a country that depends on oil and gas industry, this study is very important to ensure the stability of Malaysia's economy and politics. Without further ado, let's find out what are the factors that affect the volatility of stock market prices of publicly listed oil and gas companies. Before we proceed, let's look at how stock markets work.
In the 1600s, the Dutch East India Company employed hundreds of ships to trade gold, porcelain, spices, and silks around the globe. But running this massive operation wasn't cheap. In order to fund their expensive voyages, the company turned to private citizens, individuals who could invest money to support the trip in exchange for a share of the ship's profits. This practice allowed the company to afford even grander voyages, increasing profits for both themselves and their savvy investors. Selling these shares in coffee houses and shipping ports across the continent, the Dutch East India Company unknowingly invented the world's first stock market. Since then, companies have been collecting funds from willing investors to support all kinds of businesses. And today, the stock market has schools, careers, and even whole television channels dedicated to understanding it. But the modern stock market is significantly more complicated than its original incarnation. So how do companies and investors use the market today? Let's imagine a new coffee company that decides to launch on the market. First, the company will advertise itself to big investors. If they think the company is a good idea, they get the first crack at investing and then sponsor the company's initial public offering, or IPO. This launches the company onto the official public market, where any company or individual who believes the business could be profitable might buy a stock. Buying stocks makes those investors partial owners in the business. Their investment helps the company to grow, and as it becomes more successful, more buyers may see potential and start buying stocks. As demand for those stocks increases, so does their price, increasing the cost for prospective buyers and raising the value of the company's stocks people already own. For the company, this increased interest helps fund new initiatives and also boosts its overall market value by showing how many people are willing to invest in their idea. However, if for some reason a company starts to seem less profitable, the reverse can also happen. If investors think their stock value is going to decline, they'll sell their stocks with the hopes of making a profit before the company loses more value. As stocks are sold and demand for the stock goes down, the stock price falls, and with it, the company's market value. This can leave investors with big losses, unless the company starts to look profitable again. This seesaw of supply and demand is influenced by many factors. Companies are under the unavoidable influence of market forces, such as the fluctuating price of materials, changes in production technology, and the shifting costs of labor. Investors may be worried about changes in leadership, bad publicity, or larger factors like new laws and trade policies. And of course, plenty of investors are simply ready to sell valuable stocks and pursue personal interests. All these variables cause day-to-day noise in the market, which can make companies appear more or less successful. And in the stock market, appearing to lose value often leads to losing investors, and in turn, losing actual value.
Without further ado, let's discuss about the volatility of stock market prices of public listed oil and gas companies in Malaysia. But let's look at the problem. Crude oil prices are falling, and thus leading to the major oil and gas companies' stock prices to be very volatile. Oil prices shocks have a greater impact on the economy during long periods of stability compared to the volatile environments. No significant direct effect of oil dependency on the economic growth in Malaysia. However, there is a significant impact on the financial development of the country. But is this really important to discuss? By having an efficient stock market, it improves investment opportunities and increases overall capital market efficiency. It also encourages economic growth, increases liquidity for assets, and good platform for fundraising and investments in general. In this video, we will be covering 6 main aspects to analyze the factors affecting the volatility of the stock market prices of oil and gas companies in Malaysia, in which consists of political, economic, social, technological, legal, and environmental. These aspects are usually known as PESTEL analysis tool. First of all, the political aspect. The Organization of Petroleum Exporting Countries, or known as OPEC, is a key determinant for financial performance of a country. OPEC controls 40% of the world's supply of oil. From a political instability in the Middle East causes oil prices to fluctuate, as the region accounts for the lion's share of the worldwide oil supply. Second is the economical factor. A negative shock in oil prices will actually have a negative impact in the aggregate market of Kuala Lumpur Composite Index in the Bursa Malaysia markets. And as well as high volatility in oil prices is responsible for creating unstable economic conditions and lowering the stock market prices in the end. Third is the social factor. There has been societal pressure to discover alternative and renewable energy sources such as solar, wind, or hydroelectric power. And if extracted efficiently, will offer more affordable energy in the form of electricity and heat than fossil fuel combustion plants. Consumers will choose this as it is cheaper and environmental friendly, thus resulting in a short-term drop in oil price until the supply is adjusted to meet the new demand. Next is from the technological standpoint. There has been improved Internet of Things technologies to keep crude oil production's prices low and increase profit. Poor technology development in crude oil industrials will lead to poor competition and hence will eventually lead to the stock markets being volatile. Fifth is the legal factor. With the revised Paris Agreement with the United Nations Framework Convention of Climate Change, a burning question poses us all, in which what impact it will bring to oil and gas companies. In 2012, the NGO 350.org launched a Go Fossil Free divestment campaign, and the movement has affected around $50 billion in assets so far. Changing energy policy initiatives alone are not sufficient to account for the volatility in company stocks returns. Factors such as debt to equity and company size, as well as systematic risks, which are market oil prices, foreign exchange rates, and actual and expected stock market indexes, are also can affect the return of equity for oil and gas companies. Last but not least is the sixth factor, which is environmental. So because of climate change, natural disasters seem to be worsening year by year, and this is evident even back in 2005. After the hurricanes Katrina and Rita hit the Gulf of Mexico, Chevron Corporation, a major oil company, has lost around $1.4 billion in the second half of 2006 because of the reduced production and added costs for repairs and maintenance for both offshore and onshore facilities. That's all for another video, and thank you for watching.